So there's two parts to a DSCR loan to qualify. There's you, and then there's a property. So it's a little different than conventional conforming or even bank loans, where the income is based more on you and not the property. So what is it that you need to qualify for, and what about the property? So you qualify first and foremost is your credit score. The higher the credit score, the better your terms are going to be, which means lower rates, higher loan to values. So the better your credit score, the better the loan you're going to get. That credit score, if you're an LLC, could be the highest of the partners. So if you have 2, 3 partners, you could use the highest credit score for, the partner that shows the best credit. So that's a good thing when you're looking at, putting these in an LLC. Make sure your partners have good credit. Now, when I say good credit, lenders are looking for credit scores in the mid 700s. Yes, there are options for under 700, but for better terms, once again, rates and LTVs, the higher the score. So we're looking at mid to high 700s. And that impacts you. That impacts you and your cash flow. Because if you imagine a better rate, every month you're getting more because you're paying less. So credit scores are important in DSCR loans and every loan. So as investors, you really should, focus and get that credit score up before you apply. So number one, you qualify with your credit score. Number two, money. You need at least 20% down. Typically, I know there's products out there that do 15%. You're just going to pay with a higher rate. So you need 20% in an account that can be verified. You're also going to need reserves if it's for a purchase and or a refinance, because the lenders want to know that you can cover some payments, if the property sits vacant. So they're going to look for 3 to 6 months of the payments in a reserve account. That could be a checking account, a retirement account, an investment account, anything like that. So real simple, the basics for qualifying for yourself is your credit score, and the money for the down payment and reserves. Next, the property qualifies. Totally different than conventional conforming bank loans because a DSCR is based on the income of the property. They're not looking at your tax returns. They're not looking at your job history or if you just started a job, anything like that. It is based on the property. And don't worry, we have a great quick calculator I'm going to show you how to use just to make sure your property qualifies and hits the ratios, which means cash flow for you. So that is number one, how properties qualify, and it's cash flow. They're looking to make sure the property, meaning the lenders, are making sure the property at least breaks even. They want to make sure the rents coming in equal the expenses that they, use to qualify, which is your mortgage payment, your property taxes, your property insurance. If you have HOA or flood insurance, they check those things too. So the expenses have to at least equal the rents. Now that's the minimum, 1 to 1. You want it to at least break even. I mean, ideally what you're looking for in a ratio is a higher ratio because the higher the ratio means more cash flow for you. Every month, more money in your pocket. That's what we look for in DSCR. And I want to show you on our calculator exactly how that looks. We got a really fun, fast calculator. You see if any property qualifies based on the inputs you put in. But there are options out there if they do not cash flow. You're just going to pay a higher interest rate and get a lower loan to value. So cash flow is important. Number two, type of properties. Is it a single family? Is it a condo? Is it a multifamily like a 4-plex or 8-plex? Or is it a mixed use? So all of those factor into your DSCR. The bread and butter in the DSCR market is a single family up to a 4-plex, but single family is the easiest and gets you the highest loan to values and really the best rates. Number three, location and value. Some lenders, depending on the size of the community, may lower the loan to value and raise the rate. The same thing with the appraised value of the property. If it's under $100,000, not all lenders will lend on that kind of property, so you have to shop around when your property is under $100,000. So it is cash flow, it is the type of property, single family condo, and it is location and appraised value. But most important on DSCR is cash flow. This is the main thing that everyone looks at. We have this great, easy to use calculator. I wanted to jump in and just show you an example of how it works and how you could qualify a property before you buy it, just to make sure it qualifies for a DSCR, but also qualifies for the cash flow you're looking for. So cash flow is king in DSCR loans. The lender just wants to make sure the property can make the payments. You also, as an investor, want to know if the property is going to not only make the payments, but make you some money. Besides growing wealth and paying it down over time, cash flow every month would be nice too. So let's jump in and look at this calculator because it'll show you with just, moving a couple buttons, putting 3 or 4 things into it, if a property is going to be negative online, at least breaking even, or in the money, getting you some cash flow. So here's our DSCR calculator. Quick calculator. You're going to be able to quickly see if an interest-only 30-year AM or 40-year AM work is in the money or not. Let's do a few things. What you can see is we can move the amounts of any of the fields that have the little dots. So let's just say this property is 200, because I could also just input it. Let's say the rate is 6.5%. Let's change the taxes to 150, and taxes, insurance is 200, and HOA is nothing. Let's just say if we leave it as is, don't do much to it, we could get 1150. What you're going to see is this property on the right-hand side, interest only 30-year fixed and 40-year AM, all the DSCR ratios show red, which means it's not qualifying, it's not cash flowing, it's not 1-to-1 based on the mortgage payments, the taxes, and insurance. And if you look at the bottom, that means it's poor. That means it's under 1%. You're either going to have to lower the amount that you're borrowing. So you could do that, and you can find out where, at least on interest only, it starts breaking even, and or on the 40-year or 30-year. So it is a great tool just to see where you would need to be on a property like this. Or there might be another angle. It might be, well, if I add a bathroom or if I fix things up in the property, I could maybe get $1,400. And now you can see that everything turns yellow. At least it qualifies. Might not be the best cash flow, but at least it's qualifying. You can see on the 30-year here, the monthly rents are $1,400 that we just put in, and the monthly costs are $1,298. So you're making about $100 a month. But once again, you could say, well, what if I add a bathroom or convert something or finish a basement out, and we could get rents up to $1,750? Then you see everything turns green, which means it's a really good DSCR ratio. You'll get better rates over 1.25 with most lenders because they understand this is a quality property that's bringing in a lot of income. So you're going to look at putting in the information, seeing where the cash flow of this property is, and do this on every property you're looking for. This is set up for you before you go out to your lenders, before you talk to anyone else, to make sure you have a good property, and or if you know where you're going to be able to refinance it out based on the current rents, based on the current property taxes, anything else like that. It is a great starting point. It is so easy to use, and that's why we did it. That's why we made it easy, so that you could go and look at any property, any deal you're doing, and quickly figure out before you talk to the lender where it's going to be. And when I said where it's going to be either red, yellow, or green, meaning below 1, right around 1, maybe a little bit higher, cash flow all right, and green, which means really good cash flow for you. So remember, DSCR loans, different than conventional or bank loans. You are part of the qualifications, but the property is the main driver here as far as the income. Just know your numbers before you're out there shopping for rates. The more you know, the more you're going to be in control of, the terms of who you're working with for rates and everything. And just make sure you understand where your property sits for your cash flow and your portfolio. Also, check out our other calculators. We have some great calculators, some courses. We're here to make sure you understand, get comfortable with money so you can spend most of your time just finding properties. And also coaching, if you're really looking to get that first deal done, someone to walk you through from, start to finish, get that first one done. So, number 2, 3, and 4 get easier and easier. We find that most people are just not comfortable with the money side, so they put it off, they delay some things. The faster you get into real estate investing, the faster you get a deal done, the closer you are to that freedom and wealth you're looking for. Thanks again. We'll see you on the next video.